He gave us some really succinct tips on like how can you save money on your taxes, especially if you're a real estate investor. Also, if you're just a W-2 earner. But
so one of the things that I like to recommend to anyone who signs up with me for like year-round tax planning is we should meet up quarterly, right?
How does one write that off? You pay for it, and then like, do I provide a receipt at the end of the year?
If they ever need to go to any type of like daycare or something while you have to go to work, you can get a tax credit for that as well.
I think about the hybrid real estate investor / W-2 earner still. Like, how can someone write off their home office?
Standard method is a given rate per square footage. So you would just take the square footage of your office, multiply by the standard rate, and that would be your deduction.
Do you have a book maybe that you would recommend people read if they want to understand the taxes implications?
The CPA is 4 exams, and one of them covers tax, maybe 1.5. And I actually haven't taken the CPA, but it's 4 tests, and only really one of them really covers in the tax.
What's up, everybody? As always, it's your boys, Ryan and Corey here, back with another episode for you. Today, we had on special guest, Grant Dougherty. Grant is an enrolled agent and also known as the Small Business Tax Pro. So he owns Dougherty Tax Solutions based in Houston, Texas, where he helps both small business owners and real estate investors optimize their businesses and save money by paying less in taxes.
Yeah, we wanted to bring on essentially a tax pro for this episode. It's probably been like 50 episodes or so since we had someone dedicated to taxes. And some of this is selfishly because we're literally in the process. We're like, we need to find a new accountant and someone who can do tax planning for us based on some of the new income streams that we have coming in, just because we're like, this is something new for us and we're making more money, which is a good thing. So he's really big on social, like Twitter, Instagram, and he came on and he gave us some really succinct tips on like how can you save money on your taxes, especially if you're a real estate investor. Also, if you're just a W-2 earner. But he gave us a lot to work with. He's very in the details, and he told us a lot that we really didn't even know. So it was a really good episode.
I couldn't agree more. I think we should bring him in to let him walk everybody through. But I would stick through the end. Maybe grab your pen and paper because it is a lot of nuanced things and in the weeds conversation, right? So there's going to be a lot of terms that you might not know about. He talks a little bit quick, so you might want to write them down and Google them later. That's probably what I would do. Just a couple things. But without further ado, let's bring in Grant. Grant, officially welcome to the show. Corey and I are so excited to have you on here to drop some knowledge on us on the accounting side of the business.
So EA is an enrolled agent. So in the tax industry, there's a few certifications that carry the same way. You have CPAs, which is the most popular term, Certified Public Accountant. You can also be a lawyer. A lot of tax lawyers actually prepare taxes and things like that. Then you also have enrolled agents, which is the highest designation given by the IRS. And when to become an enrolled agent, you either have to work at the IRS for so many years, and then you're like granted this credential, or you have to pass a series of tests very similar to like a CPA. And what's the difference between a CPA and an EA? Well, CPA is Certified Public Accountant, and CPAs are specialized in overall general accounting, right? So tax falls under CPA skill sets, but if you get your CPA license, you may not actually go and work in the tax industry. You may go and do audit. You may go, work at a Big Four and do something else. But if you are an EA, you are specifically only, you study tax. So the way I like to look at it, the CPA is 4 exams, and one of them covers tax, maybe 1.5. I actually haven't taken the CPA, but it's 4 tests, and only really one of them really covers in the tax. Whereas the EA is 3 tests, and all 3 cover taxes. I went to school to study finance and accounting. I went to Prairie View A&M University. I actually went there on a baseball scholarship, and as I was there, I studied business, finance and accounting. Once when I graduated my undergrad there, I made some really good connections. I went on to get my MBA. I got some scholarships to help pay for my MBA as well. And then shortly after that, I actually got hired to work in corporate America. I actually started, my first job was a finance role. And then late at night, I started my role. And then, as time went along, I started to actually build up my own side hustle, which was, it started off as bookkeeping, and then it evolved into taxes. And then once when I started to really get involved with it, I actually stepped away from my corporate America job, and I started my own firm. And I've been doing this now for about 5 years now. So, that's kind of how I got started. It took a lot of connections, right? You don't just know everything right off the bat. You have to make connections. And that was probably one of the biggest things was getting to know other CPAs and EAs, and like almost just mentoring after them. I would fill out a tax return, send it over to them, like make sure that everything was right. If I had a question with something, I'd reach out. And, just time and time again, it actually took a lot of humility to really learn as much as I did.
Well, it's interesting, Grant. We talk about real estate investing all the time, and investing in general, building wealth, and but specific to real estate investing, we talk about like these 4 pillars of how you're building wealth with it. And it's obviously the appreciation of the property, the loan pay down, the cash flow, which everyone talks about. And then there's these tax benefits, which is like a golden goose here that is not really we don't dive in all the way on it on our podcast because we've only had a couple CPAs on. So every now and then we talk about it, but the big time investors always talk about how that could be actually the number one, maybe benefit, right? Of real estate investing. So before we get into the nitty gritty of that stuff, we always talk about tax planning and tax preparation.
Yeah.
Is there a difference in your eyes? Because I know certain CPAs and EAs do one, but not the other. Is there a difference?
Yeah, no. Tax preparation is, you could just think of it as like storytelling, right? You come to me with your tax documents and I just prepare your tax, I prepare your tax return and boom, we're done. Tax planning is more forward thinking. We right now in 2022, June 15th, we would plan for the rest of the year on what your situation is. It's very active, constantly checking in with your accountant. So one of the things that I like to recommend to anyone who signs up with me for year-round tax planning is we should meet up quarterly, right? We should try to get those quarterly estimated payments down. And whenever you do that, whenever you know your numbers like the back of your hand, you can now make moves that could impact your tax situation, right? So do you want to do a cost segregation analysis? Do you want to do a 1031 exchange, right? There's so many different avenues that you can go into whenever you actively plan. You can see all of your options.
Very cool. I appreciate that. And it sounds like to me, the benefit here is if you just have a W-2 job and you get taxes that are taken out, it makes it a lot more simple, and that would probably follow more under the tax preparation. You may not have to do that much planning if that's your only source of income. And then
don't let people fool you. There's a lot you can do with just a W-2 job.
Sure.
There's a ton of strategies. Again, it would probably largely involve purchasing real estate. That's where the bulk of your strategies would come from if you just had a W-2 job. But there's backdoor Roth IRAs, there's HSAs, there's other retirement planning strategies that you can implement. And especially if you make below that 150K target, that 150K is very important because, if you make below that, you can just purchase real estate. And if you do what's known as active participation, then you can use your passive losses to offset your active income, which is not something that generally can happen with real estate. You generally have to meet real estate professional status while doing material participation, which is a much stricter test to meet than active participation.
Okay, cool. I guess the reason why I brought it up is because we're now getting to a point where we're making revenue from several different areas, and 3 of the areas we don't have any taxes coming out when we receive revenue, like when we make money. Real estate, the podcast, and then some of the e-commerce and automation online ventures that we're doing. We're not getting taxed up front on it. So the planning and the preparation seems like for us, it's something that we really need to implement here, because taking the right amount out of each time you get paid is so important, or you're going to have this huge tax bill at the end of the year. Obviously, having a big tax bill is a good thing. You're making a lot of money, but you need to know what it is, right?
It stings, doesn't it?
Yeah, it does. Absolutely. This will be our first year. Really, will sting the hardest, which means we're making more money, which is good. But yeah, I've been in situations with people who maybe have their own LLC and they're collecting money. however they get paid, and there's no taxes coming out at the end of the year. For example, my sister, she's an influencer, so she gets paid contractually through a bunch of different brands, and she just had to recently be like, oh, okay, like at the end of my year, I'm paying X amount of dollars, 30 something percent of my income, and she thankfully is working with an accountant. But if it's not being taken out up front, it's really something that you have to do quarterly, like you mentioned. So I think appreciate you bringing that up.
Yeah, I mean, one of the things that I like to do to plan around situations like that, I like to break things down literally to its most basic complex, right? You can focus on the very complex things, but the complex things really become a lot more simple when you know how to do the basic things, right? So, starting from the very beginning, one of the most easiest things that a real estate investor, business owner can do is get multiple bank accounts, right? You have your main account for all your expenses that you all your income that you earn, all of your miscellaneous business expenses will come out of your main account. And then you have a second account open for your taxes. So, as soon as you make that income, immediately dish it out to your tax account and just let it sit there. And that's going to be what, that's how you save, that's how you budget. And then you can take this method and expand it out or contract it in as much as you want. I have 4 accounts. One for my main account, one for taxes, one for my payroll, and then also one for distributions, which is something for S corporations, which is a little bit different than rental real estate. You would not want to put your rental real estate in a corporation.
So that's a good segue. I kind of wanted to see if you can give us, we have a lot of real estate investors or aspiring real estate investors that are going to be listening to this episode. And I think they have the question all the time is like, it revolves around S corps, C corps, LLCs, like just business entities and like structure. Mm-hmm. Do you have like a blueprint or advice for people on how to set up their business structure to have everything funneling into the machine to make it like a well-oiled machine going forward?
Yeah, no, that's a good question. So luckily with real estate, simplicity is going to take you a long way. So you could go at it as a sole prop or a partnership. But, as I said before, I would not put rental real estate into a corporation. Now, every situation is different. And depending on what your situation is, it may make sense to put property into, for you to have your rental business taxed as an S corp or a C corp. Really C corp, probably not even really an S corp. S corp, you can just toss that out of the way. And there's a couple of reasons why that it's like that. So for one, with a corporation, if you do not own 80% or more of all the shares in the business, then moving an asset like a rental, an apartment building or an office building into your corporation is a taxable event. That's one of the most hidden taxable events that a lot of people don't even realize whenever they open up a corporation. You want to own over 80% of that corporation. Not to mention all the basis issues that go along with that. And if you have a partnership, moving property back out of the corporation. Again, if you don't own over 80%, that's taxable. Actually, I take that back, because whenever you move property out of the corporation, that's now a capital gain. So all the shareholders would be hit with a capital gain when only one of the shareholders is taking the property and walking out. So that's a big issue. With S corporations, you also have officer compensation, which is whenever you have S corporations, business owners will make the S corporation election so they can avoid the amount of payroll, which is Social Security and Medicare taxes on their wages. Well, naturally, rental income is passive, is not subject to any of those taxes. So you would have this S corporation to, the whole reason of having it is to avoid payroll taxes, but the rental income isn't even going to be hit with those taxes. So now you're paying extra money to your tax preparer to do a corporation return, and you're not even getting any real benefit. Not to mention, S corporations, they are required by law to have officer compensation, which is a W-2 salary. And that W-2 salary now has those FICA, those payroll taxes added in. So you essentially took income that was not going to be hit with any Social Security or Medicare, and you turned it into income that you now have to owe taxes on. So that's probably one of the biggest things with S corps is you got to watch out for that officer compensation.
Cool. I think that's great. Did you have something that you want to go into?
Yeah. So I guess I almost want to give like do like a case study or like an example of someone, it's going to be hard to break down, but I think let's just go to like a basic investor, a real estate investor that has like, let's say 5 properties with a partner and they both have W-2 jobs. What do you recommend for a small scenario like that for people to, and maybe they want to say, hey, can we start, can I buy myself a computer and write it off through the business? Hey, can I write off my car? Like, can you just talk to a scenario or the best case picture for people to save money on pay less in taxes, right? And then like talk to write-offs, like how people that we always talk about write-offs and people think like they can just get something for free because they own a business, but I know that's not the case. And just like how that actually works would be, in layman's terms, would be awesome.
Yeah. So first off, I think you bring up a good point. A write-off is not free money. A write-off is more like a glorified discount. So in the way how you would find out what that discount is you can look at what your average tax rate is, which can be found by taking the total tax that you paid divided by your total AGI, and that's your average tax rate. And whatever your average tax rate is, that is what your discount is. So if you write off $1 and you have a 20% tax rate, you're saving 20 cents for every dollar that you write off. That's a quick way to kind of figure out what your discount. Of course, you got the issue of, once when your income gets so low, now you change tax brackets. So, there's more to consider whenever it comes. But overall, that's a very simplified way of looking at it. And now what can you write off? So the IRC tax code says that anything that is ordinary, necessary, and reasonable for your business to incur to make a profit is deductible. So if you need a computer, that is deductible. If you need a vehicle, as long as it's reasonable, right, you can get deductions for purchasing that vehicle. Homeowners insurance, real estate taxes, mortgage insurance, all that stuff, mortgage interest, all that stuff is all deductible on your tax return if you are a rental real estate investor. Interesting.
I think that's really cool. I wonder, like, based on that, if you have, let's say you use Rye's scenario of like 5 properties that you own between, 50-50 owners. We've talked about some CPAs or tax planners will say, well, you should put each property in an LLC. Some will say have one LLC for 5. Some will say put a couple in each. Some will say just go buy the real estate and then deal with the LLCs later. I'm just curious, like, what your take is, because everyone is always asking, like, they think they need to get an LLC before starting. And in reality, we bought some properties and then transfer them later. And like, I just wonder what, in terms of liability, what your take is there.
Yeah, well, for liability purposes, I would have an LLC, right? That's the entire reason for having the LLC, is to protect yourself from any type of liability. For tax purposes, it does not really matter if you get an LLC or if you don't. You are still entitled to take any expense that is ordinary and necessary in your business. Now, as far as I have 5 properties, do I put all 5 of them into their own separate LLC or all into one? You would probably want to talk with a lawyer about that so that you can understand what the liability consequences are of doing something like that, right? If you have a tenant that sues you in property A, can they have claim to property B, C, and D because they're all under the same LLC? That is something that you would want to talk with a lawyer about. And there are plenty of really good tax lawyers out there. That area is a little bit out of my spectrum of knowledge, but I do understand the general idea of why you would want to either have it like this or have it a different way.
Totally.
Cool. So I'm thinking back to the write-offs again. And right, it's like I just think about us, and I'm thinking about the computer option is like, okay, so say there's a $2,000 computer that we need for work. How does one write that off? You pay for it, and then do I provide a receipt at the end of the year?
Yeah. So a computer would technically actually be depreciated. So as far as the real estate investor, what do you need to do? I would start first by having my business bank account linked to my QuickBooks, right? So you have the transaction logged onto your QuickBooks, and that's how you can keep track of your profit and loss statements. Now, you will also be issued a receipt for your expenses. You need to save that receipt, take a picture, store it into your QuickBooks, store it wherever you need to make sure that you have that documentation. You don't need to show that to your tax professional. You just need that receipt in the event that you ever get audited and the auditor says, hey, where is this $1,000 expense? Like, can you show me why it's $1,000 on your tax return? You need to pull up the receipts and it needs to add up to $1,000. As far as just claiming the expense, it really is just as simple as logging it into your tax return. So depending on if it's an asset like a computer or a vehicle or a rental property, in my software, I have to log it in as an asset, and then it spits out the depreciation based on either bonus depreciation, generally, general standard depreciation or whatever the case may be, and then it shoots it out. But, for something like supplies or, contractor expenses, it's just as simple as you typing in the number on your software and it just pops up on your tax return. So,
for example, let's say I make, we'll go even numbers, 100 grand in W-2, and then we brought in, just say 50K in real estate income from the properties. How does that $2,000 play into effect that 150 at the end of the year? Oh, say we're over. I know you said the 150 and below is like the threshold. Yeah. Like say we go over the 150.
Okay.
It's like 165. How does that $2,000 play into that?
$2,000. Hold on. Where'd the $2,000 come from?
From the laptop, the computer.
So whatever your rental income is, if you have the computer specifically for your rental business, then it would lower your rental. It would lower your rental profit, your rental revenue, and so whatever your taxable income is from your rental property would be slightly lower.
Would it be $2,000 lower, or just like you just get X percent of that as a write-off?
So your taxable income is $2,000 lower, but your tax bill will be $2,000, or whatever the amount of depreciation you claim times your average tax rate. That's how much in tax you would save. So if it was 10%, you would save what, 2,000 times $200. Do I got that math right? Please tell me I got that.
Yes, sir. Yep.
Okay, cool. Yeah. So you would save $200 on your tax bill.
Okay, cool.
Yeah.
So it's interesting. There's layers to this.
Yeah, absolutely.
Can you explain what an S Corp, a C Corp, and an LLC are, just in layman's terms for people to understand?
Yeah. An LLC, limited liability company. By default, if you submit an LLC to your Secretary of State for whatever state you live in, by default, you will be a sole proprietorship for tax purposes. Now, you can elect to be taxed as either an S corporation or a C corporation, depending on your situation. 95% of all corporations, it may be around 95, are going to be S corporations. They're a lot more favorable for small business owners, but there are some really good implications for being taxed as a C corp. C corps get a lot of hate for the double taxation, but there's avenues that you can work around that, you can work with that, to where C corporations are actually a lot more favorable. But it's just tax entities. You actually, there's four that the IRS recognizes: sole prop, partnership, S corp, and C corp.
Cool. Next one, I think a lot of people will be interested in this, is people have worked from home for a long time, right? Due to COVID. And I think about the hybrid real estate investor / W-2 earner still, how can someone write off their home office as an expense?
Yeah. So you'd have to, first, you can't do it if you're only a W-2 employee. You would need to be a business owner. That would be the only caveat, or you have to be self-employed, and so that would be the only caveat to that. But the way how it's set up is that whenever you have a home office, you have the square footage of your office, and then you have the square footage of your entire living space. You have two options: the actual method or the standard method. The standard method is a given rate per square footage. So you would just take the square footage of your office, multiply by the standard rate, and that would be your deduction. Now, the actual method actually takes into account the actual expenses incurred. So you would have direct expenses and indirect expenses. Direct expenses, of course, would be expenses directly related to your office. So if someone came and busted my window, if I wanted to put a new door in my office, I could fully deduct that amount on my tax return. But things like my real estate taxes, my mortgage interest. So earlier this year, I had to replace both my furnace and my air conditioning unit. So I would get partial write-offs, indirect write-offs for those. And in fact, actually the furnace and the air conditioning unit would technically be added to the basis of my entire home. And then you can actually claim depreciation on your home on the home office expense. So that would increase my basis, which would then increase my depreciation deduction on my home office expense.
Yeah, I was going to ask you about the depreciation specifically. Now that you brought that up, it was a good segue. Can you just explain that? Because what people generally think about depreciation is like if you buy a car, you drive it off the lot, it depreciates 30%. And we're not talking about that as it relates to depreciation on a property. I know you can depreciate over, I think it's 27 and a half years, but just if you can give an explanation on that as it relates to real estate.
That's a really good question. So depreciation, in essence, is the loss in value of an asset over time. Well, the cool thing with real estate is that real estate generally appreciates. So, that's one of the reasons why you have this big wealth bubble with real estate is you have these assets that are appreciating while they're claiming depreciation on their tax return. So they have this massive gain that's just building. And essentially, like you said, the idea of depreciation comes from the idea it loses value over its time. So there's wear and tear on an asset over time, so it's less valuable. You run across this a lot with vehicles. And so the IRS actually allows you to write that wear and tear of the item off on your tax return. Now, there's a lot of really cool strategies for specifically real estate investors when it comes to depreciation. The name of the game is find ways to accelerate expenses and defer income for as long as possible. And with depreciation, you can actually use a method called cost segregation to speed up the amount of depreciation that you claim in a year. So, for example, like you said, residential properties are depreciated at 27 and a half years, and commercial properties are depreciated at 39 years. Well, those properties are made up of things like your plumbing, your lighting, your fixtures, your carpets, your tile, everything that makes up a building that's not actually part of the structure. And these are all depreciated at much quicker rates, like 5, 7, 10, 15 years. And because of bonus depreciation and the Section 179 expense, a real estate investor could go and buy, let's say, a $100 property just for, simple math sake. They buy it for $100. Well, the average cost segregation analysis it'll immediately depreciate between 15 and 30% of the property in the year that you do the cost seg. So if you have a $100 property, and $30 of that is things like your carpets, your tile, things like that can be depreciated at much quicker rates. Now you get a massive deduction. And so almost none of the rental income that you have for that year, or in a lot of cases, the next year and the year after that, you won't pay any taxes on because of this loss that carries over year after year.
So basically it's a math formula to tell you whether or not the cost segregation study is worth it. Typically it is, but the cost segregation study is you pay a decent amount of money to have these things done, correct?
Yeah, you do. So, there's a lot of innovation in the space. So generally, if you have a massive building, you want to get an engineering firm. The engineering firms are going to be, top of the line. And whenever you start talking about smaller residential properties, you want to find, someone like a specialist to come out and do it for a lot less. There's actually also apps out there that you can take, all the configurations of your property, you can install it into the app, and the app is supposed to be pretty legit. And it'll actually spit out, of course, it'll probably be a lot less than if you were to get a professional out there to actually analyze it. But the app will spit out what your cost seg would be. So what is a ballpark estimate of when you probably should? I would say, whenever you own a property of $500,000 or more, you should definitely consider it.
So that's a great tip. That $500,000 or more number makes a lot of sense.
Yeah.
Cool. So if you could, I think people are going to want to hear a little bit of the X's and O's, right? From you're clearly an expert in this field, but can you talk to like a bunch of different strategies or a few strategies that real estate investors can implement to minimize the amount of taxes they pay on their earnings each year?
Yeah. So, probably the easiest one for most people to meet would be the mom and pop real estate loophole. Essentially what it is, I think I talked about it earlier. If you make under $150,000, and this is modified adjusted gross income, you make below 150, then all you have to do is meet active participation, and your rental losses can offset your active income. And I said modified adjusted gross income because it's very important to distinguish that between MAGI and AGI, because a lot of deductions that are allowed for AGI actually need to be added back to get to your MAGI. So it's very important to understand what counts for what and what will get added back. So that, there's a lot of planning that goes into that. Quick tip, 401ks are good to go. So max out your 401k, and that actually counts as a deduction for your MAGI. But things like HSA deductions, IRA deductions, student loan interest deductions, all of that has to get added back to your MAGI. So you probably want to not use that as the bulk of your tax planning of reducing your income. But after the mom and pop loophole, there's a few others. So, like I said, rental income is passive by nature. And then, the idea, if you had a high W-2 job, you'd want to find a way to take that passive and turn it into active. One of the ways you can do that is qualify as a real estate professional, in which you materially participate in all of your properties, right? And if you do this works really well with married couples. One spouse could be the high W-2 earner while the other spouse qualifies for reps and meets material participation. They do these cost segregation analysis on all their properties, and they can offset this high W-2 income, and they just continue to repeat the process. And that works really good for long-term rentals, but there's a nice little strategy with short-term rentals where, so in the eyes of the IRS, short-term rentals are actually not considered rental activities. So a short-term rental is any activity where the average tenant stays 7 days or less. And since it's not considered a rental activity, you no longer have to meet real estate professional status to offset to turn the income from passive to active. So you would only have to meet material participation. So you see a lot of high W-2 earners. Again, one spouse works, the other one gets to go meet material participation. They work on the properties. So there's the short-term rental loophole. Once when you start to own a lot of real estate, 1031 is one of the best ways to defer taxes whenever you have massive appreciation in properties. And even if you do sell a property and you're looking at a massive capital gain, you can roll that gain over into an opportunity zone. And then, there's stipulations when you hold the property for a certain amount of time in that opportunity zone, it'll wash away your gain.
So let's talk about this 1031 exchange real quick, because we haven't talked a ton about it on the pod. And I know that it sounds like you have a little bit of experience. Tell me if this is true or not. Let's say that you were to purchase a property and then continuously 1031 exchange. Obviously, when you do that, for people that don't know, you have a certain amount of time to locate and close upon the next property. When you do a 1031 exchange, which defers your taxes, which is what Grant was just talking about. If you do that enough times and then you pass away and pass the property down to your children, does that tax get wiped out? Is that true? Or is that something that I just heard on, I don't know, some forum?
No, that's perfectly legit. So what that is actually called, and this is just current tax law, right? Like a lot of what you just said is actually one of the things that Congress is currently looking at. So even 1031s, they're trying to limit 1031s, but essentially, yeah, what you're talking about is the step up in basis rule, and that's essentially where if you pass. Your heirs, whoever gets your property, they would receive a step up in basis. Whatever your basis was, it would step all the way up to the fair market value. So the person who receives it can do one of two things. They could either sell the property and they have almost no capital gains to pay, or they could start that whole process of cost segregation, because now they have this increased, property basis. And that's what depreciation is based off. It's based off of what your basis is in the property. So you get that step up. Now you have a whole bunch of depreciation that you can start over. So now you can rent the place out, and that income is going to be tax free for the next several years because of that cost seg.
Cool. That's awesome.
Can you talk about, and I keep going back to the write-offs, but I think this just gets thrown around all the time. Can you talk to what kind of expenses actually qualify as like business expenses that can become write-offs and help people out?
Yeah. So the easiest way for me to just answer that is to say that anything that's ordinary and necessary in nature for your business to make a profit is deductible. So if you're a business owner, contractor fees, subscription fees, materials, supplies, miles, any type of gas or mileage that you spend to go, business meals are deductible. There's some stipulations with that. Business travel is deductible. There's a few strategies going, floating around the internet. They're actually pretty smart, but you plan your vacations around your business travel, and there's ways how you can make that deductible. There's a cool little trick out there. It's called wrapping a weekend. Basically, if you work Friday and then you work again Monday, then the entire weekend becomes deductible, even if on Saturday and Sunday you don't do anything for business. So that's a pretty cool little trick. But generally, anything that your business needs to operate and run is deductible, right? If you ever have that's going to be the test. If you ever have any doubt, is it ordinary for my business to incur? Is it necessary? Like, how necessary is it for us to buy this G-Wagon, right? If you don't have a real reason for buying the G-Wagon, then they may throw that deduction out. But if you have a legit reason to go and buy a new HVAC unit, or you need a big F-350 truck to carry all the supplies, to and from your properties, then that's completely necessary. That's completely reasonable.
Cool. Thanks for the breakdown there. Also wanted to touch on, you mentioned, you kind of started out doing some bookkeeping, right? And then you also mentioned QuickBooks. So I want to talk to this because, Corey and I are manually entering in our information into Google Sheets and keeping up to date that way. And then also keeping up to date on our bank statements, right? But can you talk to the benefit of having a bookkeeper or having QuickBooks, and like what you recommend, like knowing our situation now, like that's how we're running things. Is there something that you recommend for us to help optimize our, moving into the tax planning and tax preparation, and then to make our CPA or EA's life a little bit easier?
So first off, you need to ask yourself, am I good at bookkeeping? Are you good at keeping records? Are you timely? Do you know what you're doing? Do you know how to construct financial statements in the event you ever get audited? That's the first question you need to ask yourself. Second question, can I make more money if I did not spend as much time doing this bookkeeping? If I could spend this time that I have to do, and you have to figure out how much time you spend doing bookkeeping. It could be, 1 hour a week, 2 hours a week, whatever the case may be. In those 1 hour or 2 hours or 3 hours, whatever the case may be, could I be more productive for my business? Could I do something that would generate more money? If the answer is no, then I would say that you should continue to learn how to do bookkeeping. First you got to know how to do it, right? If you don't know how to do it, I highly recommend getting someone else to do it. If you do know what you're doing, then the next step is going to be, can I make more money if I stop doing this right now and I went somewhere else? Because the money that you would spend to have them do it, that's going to be a tax deduction anyway. So, but one thing that I cannot stress enough, and I run across this all the time, is you don't want to make a financial decision based on the tax implications. So like I just said, that financial decision of hiring someone on, you still have to pay that person. You get a tax deduction, so it may lower your income a little bit. But, if you're chasing the tax deduction, for financial gain, you're going to be, largely disappointed. Like I always say, it's better to make $1 million tax at 30% than it is to make $500,000 tax at 5%.
I like that. Also, yeah, I don't know. I think it kind of goes down to, I guess, your what you feel your worth is per hour, right? And
there you go.
I don't know. for me, I'm a systems guy, and I don't like scrolling through a bunch of spreadsheets, and like to have it all in one app is awesome. And I've heard very good things about QuickBooks. It seems like the staple for a lot of the stuff. So I think we might move to that. Do you use that? And is that what you see a lot of your clients using?
Yeah, so I use QuickBooks. I also know some people that use Gusto or Wave or Zero. Those are probably like the four. And then again, Google Sheets, Excel. It's not uncommon for people to still use that as their bookkeeping. It's all about how good are you at keeping your own books. QuickBooks makes it easy because you make a transaction, and once when you go in and you categorize it enough times, it starts to pick up on your activity. So if every time you go to Home Depot, you're buying supplies, eventually QuickBooks just picks it up and it just categorizes it for you. All you have to do is now go back in and reconcile your statement.
Love it.
Yeah, from a personal standpoint, Grant, like I use Mint, which I know either QuickBooks owns Mint or vice versa, whatever. But so from a personal standpoint, it's almost like a business version of that personal balance sheet, right? I like Mint because it categorizes everything for you. And I think we could benefit from that significantly, because once we hired a property manager for our real estate, it actually became way more difficult to everything else on the other side became easier in terms of managing the properties, utilities, all that stuff. And it's 1,000 times better. But actually the bookkeeping became harder because they're not paying the mortgage. So it's just like going back and forth between their ledger and our balance sheet. And I'm just like, damn, it's kind of confusing. And I'm the one doing it. And it's like, I don't want it anymore. I don't think.
I think we got to just go QuickBooks.
Yeah.
I've heard great things, which is awesome. So good recommendation. Appreciate that. I want to just there's also a lot of people that are listening that don't have properties yet. And they're like, hey, listen, like you have a tax guy on the show. Can he help me out? So I have like 4 or 5 questions. I want to just dive in for like the regular, I hate to say average Joe, but just like people that aren't full-time investors yet. So can you talk for those who are not real estate investors or small business owners, how can like the average person minimize the amount they pay in taxes each year?
Oh, that doesn't own any real estate?
Yes.
Oh yeah. First off, I would, I'm a big proponent of retirement accounts. So 401ks, at the bare minimum, max out that 401k. That's almost a given. And here's the thing: if you're like, oh, I don't want to do a 401k, then you better be doing real estate. It shouldn't be can I have a third option? I mean, there are other options out there, but you're going to want to invest in assets. And unless you're going to like invest in art or, who knows, animals.
NFTs.
Yeah, NFTs. It needs to be stocks or some type of other like equitable, maybe bonds, I guess crypto. I'm not going to just sit here and tell you not to do it. I'm not a financial advisor, but it needs to be that or real estate, one of the two. So if you're not doing a 401k, get into real estate. If you don't have either, I would strongly recommend a Roth IRA, right? We are currently at historically low tax rates right now. They're only going to go up. So you will want to have a bucket of tax-free income, at your disposable. And cool thing about Roth IRAs, you can pass that on to your heirs and they don't pay any taxes on it either. So Roth IRA, big one. HSA, get those HSAs, a lot of young people, we feel invincible now, but one day we will become old and feeble, and it's going to be very expensive to take care of us. So go ahead and get that HSA. If used properly, you could actually turn that into a triple tax-free vehicle. Pretty cool.
I got a question on that. So you're good. Okay, so that's great. So just to break it down, you mentioned the 401k and then the Roth IRA. Let's just break it down again for someone that makes $100,000, and you can max out your 401k by putting in $20,000 of that. Does that take your $100,000 of taxable income down to $80,000?
Yeah, it does.
Great. And then the same goes for the Roth IRA, right? So say you're at $100,000 and it's $6,000 for the Roth. Does that just drop you down to 194?
So the IRAs are a little different. So you have traditional IRA and then you have Roth IRA. Only the traditional gives you a deduction now, but the Roth IRA, you don't get a deduction now. Instead, what's going to happen is later, whenever you have to withdraw that money, it's going to be tax-free. So that's the caveat to 401ks, is that eventually when you do retire, you pull that money out, you got the tax deduction now, but now you're going to have to pay taxes on it when you withdraw. So actually something that, a lot of people, I just mentioned we're at historically low tax rates right now, right? So that's actually a big argument that I keep running across is like, why would I get a tax deduction now when the tax rate is really low, when I would much rather find a way to defer it and get a tax deduction whenever taxes are much higher? So that's one of the big arguments to 401ks. And I totally understand it, but you got to weigh all your options. That's why it's best to try to pick up as many buckets as possible.
Yep. Totally cool. I appreciate that. And also I want to talk about really quick, as you mentioned in the beginning of the episode, the backdoor Roth IRA. I did that this year. So I'm just curious about certain tax implications. So, right, like if you make over X amount, I don't know, maybe the amount of money, but I think it's 100.
I barely know any of this stuff off the top of my head.
No, you're good.
Yeah. That stuff changes every year. But basically what it is, you make too much money to just contribute to a Roth IRA. And essentially you're even almost to the point where you make too much money to where you can't even get a deduction on your traditional IRA. Because you don't necessarily need to be that high, but you have to be high enough to where you can't contribute to your Roth. And what you'll do, if you would still be eligible for the deduction, you would make a non-deductible contribution. Don't invest in any asset. Just let it sit there, let it sit for a few days, and then you would just roll it over to your Roth IRA. And the tax implication is you just wouldn't get a tax deduction on that contribution to the traditional. Now, if you make over a certain income limit, you wouldn't be able to get a deduction anyway. It would just be a standard non-deductible contribution to your IRA. It's that rollover part. When you have it in the traditional, you roll it over to a backdoor, to a Roth IRA, and that's essentially what the backdoor is.
Perfect. So you're just putting it into like basically like the money market holding account in your IRA. Right. A couple of days later, you're rolling it into your Roth. But when I did that, I picked a specific index fund that I wanted to roll it into, and that they just allocated the $6,000 to that, and it was very easy.
Yeah, it's a relatively simple transaction to make. But besides backdoor Roth IRAs, you also have Roth conversions, which a backdoor Roth IRA is a form of Roth conversion. But you got to think about people who maybe had a 401k before and they rolled it over into a traditional IRA, and now they have all this income that they already got a tax deduction on. Now they want to roll it over. They want to do a Roth conversion. And so what would happen is whatever the amount that you were converting over to a Roth, you would have to now claim that as income for the year. And if you do it in fast enough, then you can avoid the 10% penalty that comes along with early withdrawals.
I have to do that this year. So that's actually funny that you mentioned that. So from like just my wife's previous employer, right? They had like a simple IRA, and we wanted to get it into the Roth. So we're gonna have to convert it. When you say doing it fast enough to avoid that 10%, what does that mean?
I can't remember what the time limit on there. I believe it's within 30 days or 45 days. I can't quite remember, but there's within a certain time limit that you have to do the conversion in. Because what's going to happen is you would take the traditional IRA, you would move it out of the traditional IRA, and then you have to convert it into the Roth. So you would be taking essentially a distribution out and then just put it into your Roth.
Perfect. And I will say, just for listeners, this sounds a little bit complicated. Just call the company that you have your funds in. Like specifically, I use Vanguard. I popped online with someone. It took literally a 15-minute call, not even, and they sent me the forms, converted it. It was all good to go. And it's not like you have to learn this by yourself on YouTube the whole time. Like there's people that'll hold your hand. So just fun little fact from a guy that's done it. So
yeah. Good stuff. Well, Grant, it's pretty clear that you know your stuff here, and you have developed a big following on Instagram, and every day, it seems like every day, I don't know if you're posting every day, but it sounds like there's just content coming out, and we take a lot of value from it too. So I just want to talk a little bit about your company, Dougherty Tax Solutions, and like can you just describe the services you provide? I mean, it may sound self-explanatory, but I think after listening to this episode, people may be like, well, this guy really knows what he's doing. Maybe it's a good fit for them if they're looking for an accountant.
So some of the services I offer, of course, I'll prepare your tax return. I do tax preparation, but I also do tax planning. And in that tax planning, I have two options. You can either just sign up for the tax planning, and this is year round, or you could do tax planning and I'll prepare your tax return. So it's two different bundles. And the way how I generally work is I have some digital products that I'll provide to whoever signs up for the service. I'll leave that up to you to go and soak in as much information as possible. And then you can reach out to me whenever whenever you have any questions, you want to set up a consultation, whatever the case may be. Now, I generally suggest that you reach out quarterly. We should set up time quarterly so you can go over your quarterly estimated tax payments and you can really understand your financial picture. But if you never reach out, I'll make sure to reach out at least once in the year. That's going to be around September, October, or November. And it's going to be a year-end tax planning session. And this is going to be where we look at your income to date, what your current tax liability is. We'll estimate out what we think you may make for the next month or two. We'll give you another projection, and then we'll come up with all the different strategies that you can implement to get that tax bill as low as possible. And actually, if you guys want me to give you a spoiler, one of the easiest tax strategies that a business owner can implement is and this really only works if you're on the cash method of accounting. But if you look at everything needs to be done before December. But if you look at some fixed expenses that no matter what you will have to pay come January, February, March, and April, you can pay all those expenses in December and you can get a tax deduction on your tax return for that year. So it's a way, again, of speeding up those deductions. But the problem with doing that is that now next year, those are a whole bunch of deductions that you don't get to have. So it's almost like you got to repeat it almost every single year. So
I wanted to talk about this specifically, and it kind of goes to your last point, I think, but I've heard people paying quarterly taxes. And I'm like, damn, I don't do that. Like, we just wait till the end of the year and we just see what's the benefit and what is the strategy there? And are people forced to do that?
No. So I'm going to say it depends, right? That's going to be the best answer for someone like this. So by law, you should be making quarterly estimated tax payments. And if you don't, you actually get hit with a relatively small underpayment penalty at the end of the year. Again, it's very, very small. If you have if you owe several $1,000s, the penalty may be like a couple $100s or something like that. So the reason why some business owners decide not to make these quarterly estimated tax payments is they get to keep the cash. They can keep their cash on hand. They don't have to dish it away now that they lose access to it. They can keep it. They can invest it somewhere. They can get a higher return on investment than what the actual penalty will be. So that's like the thought process behind not making the payments. But if you ever do get in trouble with the IRS and you want to apply for any type of penalty abatement or interest abatement or anything like that, the only way that they will actually approve it is if you have been making timely payments and you are up to date on all of your payments. And this is, and if you get hit with an underpayment penalty, that means you haven't been timely. So you would automatically disqualify for any type of abatement.
Very cool. Thank you for clearing that up. That's cool. So a couple things I've heard here and people, these are I don't know if they're the myths or what, just floating around corporate W-2 jobs. People are always throwing these out I get a tax benefit for being married or for owning a primary residence. Can you just talk to those? Is that true? What are the benefits of being married or having kids, and then a primary residence? Where does that fall in and how big of a benefit do people really get?
So when you are married, you do get a larger standard deduction. And so whenever you are married, you can file either married filing jointly or married filing separately. Depending on your situation, it may be more beneficial to file as one over the other, but almost on 90% of times, it's almost always more beneficial to file married filing jointly instead of separately. Now, do they get more of a tax deduction? It depends, right? So if you were a single bachelor or a single bachelorette before you met your spouse and you were making a bunch of income and they weren't making hardly any, then all of a sudden, that's a big benefit because now you're getting your high income slashed by larger deductions because of the standard deduction. But if y'all are pretty much making the exact same amount of income, it may help a little bit. It may not. It's pretty much designed to So the standard deduction is basically exactly half of what it would be for married filing jointly. So, a lot of the benefits you get as single, you would get as married filing jointly. It's just double because now it's two people.
Gotcha.
But again, it's more beneficial to file jointly instead of married filing separate. Once you go separate, now you kind of disqualify yourself for a lot of other deductions and credits. As far as having kids, yeah, you can get a child tax credit. That's cool. On top of the child tax credit, if they ever need to go to any type of like daycare or something while you have to go to work, you can get a tax credit for that as well. If you are a business owner, you own a business, you can actually hire your children to work for your business. You can get a tax deduction for the amount that you pay them. A lot of caveats that go into that, right? You got to abide by child labor laws. You don't want to hire a 1-year-old who is technically doing roofing, right? That would for sure not fly with the IRS. But there's a lot of caveats. You want to make sure you pay them a reasonable wage. You would pay them the exact same amount as if you were to hire someone else. You don't want to get busted for overpaying them because now, not only do you get a large tax deduction for that, but they're in a much lower tax bracket. So any extra income would be taxed much lower anyway. There's just a lot of stipulations that go into hiring your children. And then of course, just recently with all the stimulus payments, the children also got stimmies as well. So, if you didn't have any children, you didn't get additional stimmy. So, whatever your opinion is on the stimmies, that would have been a benefit of having, children for that time period. And so that's just a few of the benefits. As far as the personal residence, the tax benefits really come whenever you go to sell the home, right? So the benefit is if you live in the home for 2 years in a 5-year span, you can sell the property. And if you are single, you can exclude the first $250,000 of capital gains. And if you're married, filing jointly, you can exclude the first $500,000 of capital gains. So actually, currently, my wife and I, we're in this situation right now. We've been living in our home for 2 years, almost 3 years now. We bought the home at $220, but now it's valued at nearly like $360, $370. So we're looking at a pretty large capital gain that we wouldn't have to pay any taxes on. It's just the flip side of that. It's going to buy another house with the increased prices and the increased more interest rates. It's just a whole bunch of things to consider. But
very cool.
That was awesome. Thanks for the whole explanation there. Cool. So I think we've made it to the core four, and this one will be a little bit different. Well, sort of different, but just based on the fact that you're an entrepreneur, and obviously you have your tax business here. So the question that we typically ask is, what's your favorite investing or business book? I think we'd throw in here, do you have a book maybe that you would recommend people read if they want to understand the taxes implications, maybe at a higher level?
Yeah. Well, I wouldn't be a business owner if I didn't, advertise my own ebook first, right? So y'all go check out my ebook, Tax Strategies You Can't Find on Google. I'm kidding. All this stuff you can find on Google. I just had to come up with something catchy. But some other really cool books that you guys could read. It's called Tax-Free Wealth by, oh my gosh, what's the name?
I'll look it up. Go ahead. Yeah, Tax-Free Wealth.
He's part of the, what's Robert
Kiyosaki. I just bought the book, dude. It's literally on my nightstand. Tax-Free Wealth. Wheelwright.
Yeah, Tom Wheelwright. That's
Woo!
Right. Tom Wheelwright. It's good. It's really good. Another one I like, Profit First. Profit First was a really good one. Now, if you want to talk about investing, man, there's so many of them out there. The Intelligent Investor, Millionaire Next Door. There's a bunch of them out there that are really good. But for taxes, Tax-Free Wealth is going to be probably one of the best ones out there.
Dude, that is so fire. I got one of the books from Bigger Pockets that talked about saving taxes in real estate. But I also am obsessed with Kiyosaki's books. People can say what they want about them, but the books are very, very informative. They tell a story and they're captivating, right? You're in the book. You're like, I'm good. I understand this and it feels applicable. And so I was like, hopefully this guy has a tax book. And then I saw the Wheelwright had that. So I'm like, I just picked it up. It's on my stand. I'll provide some feedback for listeners.
He's got 750 books on his nightstand.
I know, dude. It's fun. But I'm cranking through them slowly but surely.
It's real good, man. I highly recommend it. And I agree. Robert Kiyosaki's books are way better than his Twitter posts. So highly recommend.
So true. Fair enough. So question number 2, what's been the biggest mistake you've made in your career so far, and how have you learned from it?
Oh my gosh. Probably not starting my business soon enough, not having enough confidence in myself, probably. That would probably be the biggest one, right? I feel like a lot of people really underestimate how well they can really perform if they decided to really just grind, buckle down, and just, really just focus on their craft, become what is it called? You want to be a master of your craft. You don't want to be a jack of all trades, but a master of none. But I think that phrase actually goes out to, it expands out. It's a little bit more than that. But, that was probably my biggest mistake, because if I would have started my business, when I first got out of college, I didn't go and work for corporate America and kind of slow that down. I would probably be way further along in my business growth than where I am now.
Very cool.
Very cool. Awesome. The third question is, let's say somebody let's say Ryan and I were super kind and we gave you $50,000, and now you have this business, and obviously you're really good at what you do. What would you do with that money? Would you invest it? Would you put it in a Roth IRA? Would you, there's limits to that, right? But what would you do with it? What would you do with an extra 50 grand right now if we handed it to you?
You know what? So first off, I would probably, I don't know. That's a good question. So I would probably take that 50 grand. I would for sure have enough now for down payment for for our rental property. It's probably gonna be, what we spend most of it on. But I mean, depending on how much of that I spend, let's just say I spend 30K. Let's just say I spend 40K on that. The remaining 10K I would probably put towards my credit card. I have a $5,000 balance on there, so I'd get rid of that. And then the remaining 5,000 I would pay towards my wife's brand new mommy mobile that I just bought her, because she's pregnant with baby number 2, and so we need more of a tank.
Nice.
To transport the babies around. So,
okay.
Yeah, we took an auto loan on that. It's actually, the thing about auto loans is they kind of do suck, but never mind. I'm getting too far into it, man. That's more like personal finance. I'm getting off topic of taxes, but Dave Ramsey would have been very disappointed in me for financing that car. But
I've been hearing a lot of different things though about, like, originally my thought was, really wealthy people, like, they'll buy a car in cash, right? But I've been hearing more so recently that financing a car is actually a smarter thing to do than I originally thought it was. So I think it's really just like your tolerance and your taste for how you like to spend your money. But
all that cash flow.
Yeah, exactly.
Cash flow. If you pay for that car up front with cash, now you don't have that cash to go do something else, right? Well, what if I need a new computer for my business, right? I'll probably need at least $1,000 or $2,000 for my business. Now, you've strapped yourself on cash just because you wanted to not have any type of car payment. And don't, like you said, different strokes for different folks. Some people need to probably just go ahead and pay it off in cash. Depending on what their credit and credit history is looking like, they probably may not get as good of an interest rate on the loan. So a lot of things to consider.
Yeah, I think that's more so like if let's say you're buying a really nice car and there's $80,000, I think that the wealthier people get, the more so they think, well, I can make a $1,000 a month payment or whatever that might be, and use that $79,000 and go invest it in something that would pay me $2,000 a month or whatever that is, so that instead of their money being lost in the quote unquote equity of the car, it's now being in another investment somewhere. So it's an interesting debate there. But
so last question on the core 4. This one will let us get to know you a little bit more personally, but we want to know, what do you want your legacy to be? So what gets you out of bed every day to do what you do, and kind of what's your why in this game?
Oh, it's definitely my son right now, and soon to be my daughter, right? So first off, I get to work at home. I get to see them literally every single day. They don't have to go to daycare. I am their daycare. So my why is definitely, I want to provide for him first, for all of them. I want to make sure that they're they're secure in every aspect of life. So that's probably going to be my biggest why.
Yeah, man. Made it to the last drop.
Last drop.
Cool. So knowing what you know now, Grant, what advice would you give your younger self and why? Maybe if you went back to, I don't know, your 18-year-old self.
Oh, get licensed ASAP and start the business ASAP. I would, that's probably my biggest advice. It wouldn't even go back and invest in Amazon or any of that stuff. Nah, it would be go back. And when I'm in school, focus on the business whenever I graduate. That would be my goal.
Love that. Invest in you, right? That's the best investment you can make. So love that. Well, Grant, it was a pleasure having you on the show. If people enjoyed what they heard, they want to connect with you, network, and potentially use you as they are their accountant, how can people get in touch?
Yeah. So my Instagram is Dougherty Tax Solutions. Give me a follow on there. I do post daily tips on there. But if you guys want to see all the action before it reaches Instagram, they should follow my Twitter, which is DOU Tax Solutions. And a lot of what gets posted on Twitter actually does not make it to Instagram, ironically, because actually the Twitter engagement in the community on Twitter is totally different than Instagram. So my Instagram platform is more of an educational platform, right? But once you get over to Twitter, everyone over there, the community I'm in, it's all tax professionals, right? So the educational stuff doesn't really, it doesn't really click with them as much because they already know this stuff. So a lot of my engagements with the other Twitter, tax Twitter is going to be a lot more high level when we actually start diving into codes and we actually start talking about real life issues that we have in the tax industry.
Very cool. Sounds like a great Twitter follow. So that's awesome, man. Thank you so much for coming on. We enjoyed your presence here. And I think that it's a great episode to point people back to, especially when you want to talk about taxes specifically. So thanks.
No, awesome. No, thank you again for having me on. I look forward to working with y'all again sometime.
Awesome. Thanks so much, man.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.